Most people have no idea how much money they need to retire, and even fewer realize you could do it early using just one ETF. That ETF is SCHD. It's known for strong dividends, low fees, and long-term growth. But the real question is, how much SCHD do you need to retire comfortably? If you've ever wondered how much monthly income you could get from your investments, or how long it would take to hit financial independence, this video is for you. Because today, I'm showing you the exact numbers. How much you need to invest, how much SCHD can pay you every year, and how to build your position over time, even if you're starting from scratch. And stick around, because at the end, I'll reveal the most optimized SCHD retirement strategy that can help you hit your goal years earlier than traditional advice suggests. So, how much SCHD do you need to retire? Can it really replace your full-time income with just dividends? And what's the smartest way to build that position over time? In this video, I'm breaking it all down step by step. We'll calculate your personal retirement number using real dividend yield data from SCHD. You'll see how dividend income stacks up against your expenses, and how consistent investing, even $500 a month, can build real wealth. And I'll show you how SCHD's dividend growth plays a key role in making early retirement possible. This isn't guesswork. I've done the math, analyzed the performance, and built out a calculator to give you clear, realistic numbers based on how much income you actually want. By the end, you'll know exactly how far you are from early retirement and how to close that gap faster than most investors realize. Before we dive into the numbers, let's get clear on something. Why are so many investors betting their retirement on SCHD? It's not just hype. SCHD, or the Schwab US Dividend Equity ETF, has quietly become one of the most trusted funds for income-focused investors. But what makes it different? Let's break it down. SCHD tracks the Dow Jones US Dividend 100 Index, which means it holds 100 of the strongest dividend-paying US companies. But here's the twist. Those companies aren't picked just because they pay dividends. They're selected based on fundamentals like cash flow, return on equity, and dividend sustainability. In plain English, SCHD avoids the high-yield traps and focuses on businesses that can actually keep paying and growing their dividends. Top holdings include names like Verizon, Texas Instruments, and PepsiCo. These are stable, cash-generating giants that tend to do well across economic cycles. Another big plus, SCHD has a super low expense ratio of 0.06%, which means you keep more of your returns. No active manager taking a cut, just a rules-based strategy that favors quality and consistency. Its current dividend yield hovers around 3.5%, depending on the market. That's already higher than most S&P 500 ETFs. But more importantly, it's a yield that has grown steadily over time. And unlike other dividend funds, SCHD has managed to combine income and capital growth. Over the past decade, it's delivered not only strong dividend payouts, but also solid price appreciation, something income investors often sacrifice. So if you're looking for a fund that can generate real income, hold up in recessions, and still grow with the market, SCHD checks a lot of boxes. It's diversified, low cost, and built for long-term performance. That's why it's the centerpiece in so many financial independence, retire early strategies, and why it might just be the key to your own early retirement plan. SCHD sounds great on paper, but can you really count on it to carry you through retirement? Let's dig into the numbers and the risks. Over the last 10 years, SCHD has delivered an average annual total return of about 12%, including both dividends and price appreciation. That's impressive for a dividend ETF and nearly matches the broader S&P 500. And it hasn't just paid, you've gotten raises along the way. Its dividend has grown from around 27 cents per share in 2012 to over $1 per share in 2024. That kind of growth matters, because when your income rises with time, your purchasing power stays protected even during inflationary periods. But no ETF is perfect. Let's talk risk. SCHD is US only. You're not getting international diversification here, so if the US market struggles, SCHD takes a hit too. Also, its sector exposure isn't balanced. SCHD is heavily weighted toward financials and industrial sectors that can be more cyclical. In fact, it's had less exposure to high-growth tech compared to broad market ETFs, which could limit upside in tech-driven bull markets. Another point, SCHD is not actively managed. That's usually a strength, but it also means it sticks to a rules-based strategy no matter what's happening in the economy. If those rules lag behind market trends, the fund could underperform temporarily. Lastly, dividends aren't guaranteed. SCHD's holdings are screened for sustainability, but in a deep recession, companies can still cut their payouts. Think 2008. If a few top holdings slash dividends, your income could drop. So here's the truth. SCHD has a solid track record. It's performed like a champ and grown income consistently. But it's not a magic bullet. You need to understand its sector risks, lack of global exposure, and the possibility of short-term volatility. Still, for many long-term investors, the strengths far outweigh the weaknesses, especially if SCHD is part of a larger strategy. Let's stop guessing. How much SCHD do you actually need to retire? This is where the math gets real. SCHD currently yields around 3.5%, which means for every $100,000 invested, you'll get about $3,500 per year in dividend income. So if your target retirement income is $40,000 per year, you'd need $1.14 million invested in SCHD. Now let's break that down by lifestyle. $30,000 per year goal. Then you need $857,000 in SCHD. $40,000 per year goal. Then you need $1.14 million, $50,000 per year goal. Then you need $1.43 million. That's your SCHD number. But it's not just about hitting a big total. Timing matters too. Let's say you're 30 and want to retire by 50. You have 20 years. If you invest $1,000 a month into SCHD, reinvest dividends, and the total return price plus yield averages 10% annually, you'd end up with future value about $685,000 after 20 years. That's only about halfway to the 1.4 million goal. But if you double that to $2,000 a month, your portfolio could grow to $1.37 million, which gets you close to $50,000 per year in dividend income. Here's the best part. This doesn't include dividend increases over time. SCHD has historically grown its dividend at about 12% per year. So your income isn't just flat, it's rising, potentially outpacing inflation and giving you breathing room. Now you've got a simple calculator. Retirement income goal divided by 0.035 equal SCHD target portfolio size. And if you know how much you can invest each month, you can project exactly when you'll get there. So no more guessing. The number's right in front of you. You might be thinking, I'm nowhere near $1 million. So how do I even get started? Here's the good news. Most people don't start with a lump sum. They build their wealth monthly. And with SCHD, that consistent investing can lead to serious long-term results, even if you're starting small. Let's run some numbers. Say you invest $500 per month into SCHD for the next 20 years. Assuming an average 10% annual total return, including dividends and price appreciation, you'll end up with roughly about $343,000. That gives you around $12,000 per year in dividend income, or about $1,000 per month. Double that to $1,000 per month, and you're looking at $686,000 over the same period, generating $24,000 per year in income. And if you stretch your time horizon to 25 or 30 years, the compounding really kicks in. $1,000 per month for 25 years to $1.16 million. $1,000 per month for 30 years to $1.98 million. That could mean over $70,000 per year in dividend income, assuming SCHD maintains a 3.5% yield. But there's more to it than just investing a fixed amount. You can use income increases, tax refunds, bonuses, or even cut expenses to ramp up your monthly contributions. Even bumping your monthly investing by just $100 more per year can shave years off your retirement timeline. Example, year 1, $500 per month. Year 2, $600 per month. Year 3, $700 per month, and so on. It's a snowball strategy, and it works. Monthly investing turns retirement into a timeline you can control. You're not hoping for a windfall, you're building a habit that compounds. SCHD gives you the vehicle. Consistency gives you the results. And once you get close to your number, it's time to think about switching gears, moving from reinvestment to living off the income. So when should you stop reinvesting and actually start using your SCHD income? Once you hit your target, say $1.114 million for $40,000 per year in income, you'll likely want to flip to income mode. SCHD pays dividends quarterly, so that's $10,000 every 3 months directly into your account. The key is to switch before you retire. That way you can test if the income actually matches your needs. One popular strategy is to phase the shift. Reinvest fully in your 30s and 40s. Go 50-50 in your late 40s. Fully switch to income mode once you've reached your number. This gives you income without sacrificing long-term stability. Reinvesting helps you build wealth, but flipping to income mode at the right time turns SCHD into a reliable paycheck that lasts for decades. You've seen the numbers, but how do you reach your SCHD goal faster without sacrificing quality of life? This is where most people miss the mark. They invest randomly or inconsistently. But if you want to retire early using SCHD, you need a strategy that's both aggressive and smart. Here's the optimized blueprint. Front-load your contributions. In your 20s and 30s, every extra dollar invested has decades to grow. If you can invest $1,500 a month in your early years, even if you reduce it later, you'll still come out ahead. Use dividend reinvestment strategically. Reinvest all dividends until you're within 5 years of retirement. Then shift to partial income mode to test cash flow. Add income boosters. Use tax refunds, side hustles, or annual raises to increase your SCHD contributions temporarily. Just one $5,000 lump sum per year can shave years off your retirement timeline. Avoid lifestyle inflation. If your income rises, keep your spending level and invest the difference. That discipline compresses your timeline dramatically. Delay lifestyle upgrades. Hold off on big purchases, new car, larger home, until your SCHD portfolio covers at least 75% of your target retirement income. Now for the advanced move. Pair SCHD with a small allocation to growth ETFs like QQQ or VGT during your early investing years. This increases your total return potential, especially when SCHD's yield remains stable, but growth is slower. Then shift 100% to SCHD for stable income as retirement approaches. This is how smart investors hit financial independence 5 to 10 years earlier than expected. With the right mix of early aggressiveness, strategic reinvestment, and dividend focus, SCHD isn't just an ETF, it's your early retirement engine. If you're serious about early retirement, make sure to subscribe this channel. Simplifies ETF investing for long-term success. Want to diversify beyond SCHD? Watch my video on the best Schwab ETFs to build a balanced income-focused portfolio. Prefer faster growth? Check out the 3 ETF portfolio designed to speed up your path to financial freedom.